Welcome back to the Wall Street Podcast. Today we're doing a deep dive into BofA Securities' technical advantage. Back to the charts report. It came out September 3rd, 2025.
Right. And it gives a technical look across, well, everything really. Equities, yields, FX, commodities, even emerging markets.
And it highlights September's seasonal tendencies, which are always interesting. Our goal here is to pull out the key signals for you quickly.
Exactly.
Okay, let's jump into equities. The S&P 500 hit 6,500 in August. That's big. But the report seems a bit cautious now.
It does. Despite that high, you've got oscillator divergence showing up, plus, September's historically weaker seasonality.
Suggesting maybe hedging long positions.
That's the implication, yes. Though an upside target of SPX 6,625 is still considered possible.
Okay, and the Dow Industrials hit new highs too, but I gather the transports and momentum didn't really back that up.
Correct. No confirmation there.
Yeah.
So from a traditional Dow theory perspective, that lack of broad market breadth makes the breakout, well, the report calls it mild evidence.
Not a strong all-clear signal then.
Not really. It raises questions about how sustainable the rally is.
Also seeing a note on the VanEck Semiconductor ETF, the SMH.
Ah, yes, the SMH. It's potentially forming a head and shoulders top pattern. A break below $279 would definitely be a warning sign for the chip sector this month.
Got it. And finally, for equities, the small cap versus large cap ratio.
Right, the S&P 600 versus S&P 500 ratio.
Yeah.
It's testing a really critical long-term support zone. We're talking about the lows from way back in 2003 and also a key 61.8% fib retracement level.
So a potentially important inflection point there. Okay, let's shift over to yields. What's happening with U.S. Treasuries?
The U.S. 5-year and 30-year are both testing significant levels. The 30-year yield is kind of coiling in a range between 4.82% and 5.01%.
And the expectation is for a breakout soon.
Yeah, the report anticipates a breakout potentially this month or into October.
We also saw the 530s curve steepen.
We did, broke a trend line in August. That points towards potential steepening targets around 131 basis points, maybe even 148 basis points later in 2025.
And across the pond, UK gilts.
The 10-year gilt yield also had an upside breakout, getting above 4.80%. So yields moving higher seems to be a broader theme.
Okay, let's talk currencies. FX, the U.S. dollar index, DXY.
Still holding that head and shoulders bottom pattern. As long as it stays above, say, 97.1 or 97.00, it supports a bullish view for the dollar in Q3.
Which implies maybe some weakness for the euro.
That seems to be the case. The euro is stuck in a downward channel below 1.1745. And for sterling, GBP USD, the bearish bias looks confirmed after that May July top.
A move towards 1.30 is possible there.
Potentially, yes.
All right, now for something that seems to be doing well, precious metals. The report says shiny metals are shining. Gold.
Gold made that tactical breakout move to $3,500. Now, the key is getting a weekly close above that level.
And if it does?
That would confirm a bullish triangle pattern. Targets then become $3,735 and maybe even up towards $4,000.
Wow, and silver.
Also looking bullish. A retest of those old 2011 highs around $49.80 seems plausible.
Platinum too.
Platinum's holding strong above $12,060, building off a multi-year base. Still looks bullish there.
Okay, briefly on emerging markets. Anything stand out?
Well, the EMBI global spread, that's a measure of EM sovereign risk. It's very tight right now.
Suggesting caution?
Suggesting maybe considering some hedges against macro risks, yes. Also, USD/BRL, the dollar against the Brazilian real, is testing support around 5.40.
Upside risk if that holds.
Upside risk towards 5.70. But if 5.40 breaks, you could see a move down to 5.07, maybe even 5.00.
And one specific bond, ODF 29.
That's an Argentinian bond. It's retesting yield support near 13.25, 13.00%. Holding there implies some medium-term upside potential.
Okay, let's dig a bit deeper into some of these points. That phrase, slippery September for the S&P 500, caught my eye, especially given the August high. What are the main technical warnings, and how did that August peak actually change the risk picture?
So the core warnings are the divergent oscillators where momentum isn't keeping pace with price, and just the plain fact that September is often a weak month seasonally. But interestingly, hitting that all-time high in August has sort of taken the edge off the typical September risk. The average drawdown risk historically drops quite a bit in this scenario.
From almost 30% down to
about 8.54%, according to the report's analysis. Still a risk, but less severe than the average September might suggest.
Right. Now, back to the Dow theory point. Industrials making highs, but transports and momentum lagging. What does that really tell us about the rally's health? Should we be concerned?
It tells us the rally isn't broad-based. It's not lifting all boats equally. That lack of broad participation definitely raises questions about how solid the foundation of this rally is. For followers of Dow theory, it's not panic time, but it's certainly a signal that suggests the rally might be more vulnerable than just looking at the industrials alone would indicate. It lacks that crucial confirmation.
Makes sense. Let's circle back to precious metals, the shining ones. You mentioned the targets for gold, $3,735, $4,000, and silver retesting $49.80. What broader message could this strength be sending about the economy or investor sentiment?
Well, seeing gold and silver rally like this, especially when the report notes that positioning isn't extreme yet, it often suggests investors are seeking safety or hedging. It could point to underlying concerns about economic uncertainty, maybe inflation picking up, or just general market nervousness prompting a flight to perceived safe havens. Metals often perform well in those kinds of environments.
So less about pure speculation and more about risk management, perhaps.
Potentially, yes. It suggests hedging demand is increasing.
Okay, bringing this all together, these technical trends in yields, currencies, commodities, how might these filter down and actually affect everyday financial decisions for the public?
Well, take yields, for instance. If that 30-year yield does break higher as anticipated, that could pretty directly lead to higher mortgage rates. That impacts affordability for home buyers or decisions about refinancing.
And the stronger dollar.
A stronger dollar makes imported goods cheaper for the U.S., but it makes U.S. goods more expensive abroad. It also means things you buy that are imported, like electronics or maybe some foods, could potentially become more expensive over time if the trend persists. It affects purchasing power.
And the precious metals strength.
That can be seen as a signal. It might reinforce concerns about inflation eating into savings or just general economic jitters. This could prompt individuals like you to look again at your own investment mix, maybe consider adding some exposure to assets seen as hedges.
So these aren't just abstract chart patterns, they can have real-world consequences.
Absolutely. They reflect underlying economic currents that eventually touch Main Street.
Right. So this deep dive gives us a snapshot of key technical signals BofA Securities is watching. That interplay between seasonal trends and chart patterns is clearly crucial right now. As you consider your own market views, it's worth thinking about how these potential shifts in yields, the dollar, and even metals could influence the broader landscape in the months ahead.